Hello everyone, welcome to my channel. Today I'm going to talk about balance sheet versus income statement. Before I get into the video, be sure to subscribe and leave a comment below saying I subscribe. I will try to personally reply to your comments. Let's get into the video. For any business owner, the balance sheet and income statement are essential papers. When a company has a good income statement, it almost always has a strong balance sheet, but one can be weak while the other is strong. You might be asking, what causes this and what sets them apart from one another? We can see the variance in the content of each report. The income statement shows your company's success over a certain period of time, whereas the balance sheet shows your company assets and liabilities at a particular point in time. That's only one distinction. Let's see what else sets these reports apart. The balance sheet depicts the assets and liabilities of a corporation at a specific point in time. It's used in conjunction with other important financial documents like the statement of cash flows or income statement to conduct financial analysis. The purpose of a balance sheet is to show your company's net worth at a given point in time and to notify interested parties about the company's financial status. A balance sheet is a financial statement that details the assets, liabilities, and equity of a company at the conclusion of a financial period. Assets include cash, inventory, and real estate. A company's liabilities are its financial debts or duties, which are normally arranged in order of liquidity, with the assets that may be converted into cash at the top of the list. Among them include taxes, loans, salaries, accounts payable, and other costs. The amount of money invested in the company, as well as retained earnings less any dividends paid to shareholders, is referred to as equity. The cornerstone of the balance sheet is the accounting equation, which stipulates that assets on one side equation equals equity plus liabilities on the other side, which is better known as assets equal liabilities plus equity. The concept is straightforward. A company must pay for everything it owns, assets, by either borrowing money, debt, borrowing money from an investor, issuing stockholders equity, or borrowing money from retained earnings. If a company takes out a $9,000 bank loan for 5 years, its liabilities and assets will each increase by 9,000. If the company accepts 13,000 from investors, its assets and shareholders' equity will both increase by 13,000. $22,000 assets will equal to $9,000 liability plus 13,000 equity. For the balance sheet to be declared balanced, the company's total asset must equal its total liabilities plus equity. The balance sheet demonstrates how a business uses its assets and how those assets are financed using the liability column. Because banks and investors look at a company's balance sheet to evaluate how it uses its resources. It's critical that you keep it up to date every month. On the other hand, the income statement, often known as the profit and loss statement, shows a company's financial health over time. It also provides useful information about a company's revenue, sales, and expenses. These statements are used to make important financial decisions. Both revenue and expenses are constantly monitored since they are vital to keeping costs under control while increasing revenue. For example, a company's revenue may be rising, but if expenses are rising faster than revenue, the company may be losing money. When determining whether a company generated a profit or loss for the period, investors and lenders often pay close attention to the operating component of the income statement. It not only gives relevant data, but it also compares the company's management, efficiency, and success to those of industry rivals. Revenue, product cost, and operating expenses, as well as the resulting net gain or loss for the quarter, are all included in income statements. Payroll, rent, and non-capitalized equipment are examples of ongoing operating expenses that a company faces. Depreciation and interest costs are examples of non-operating expenses that are unrelated to the primary business operations. Similarly, operating revenue is generated by core business activities, while non-operating revenue is generated by non-core business activities. In contrast to the income statement, the balance sheet shows what a business has assets and owes liabilities at any particular time, whereas the income statement shows total revenue and expenses over time. The income statement, not the balance sheet, is used to determine performance. Revenue and expenses are reported on the income statement, while assets, liabilities, and equity are shown on the balance sheet. The balance sheet is used to determine if a company's assets are sufficient to meet its financial obligations. The income statement is used to evaluate performance and identify any financial issues that require attention. Lenders examine the balance sheet to determine whether they should extend extra credit, but they examine the income statement to assess whether the company is profitable enough to pay its debts. Despite the differences, there are a few fundamental commonalities between the income statement and the balance sheet. Together with the cash flow statement, these are two of the three most important financial statements. Despite the fact that they are used in different ways, creditors and investors examine them both when deciding whether or not to invest in a business. Both the income statement and the balance sheet are important to banks and investors because they provide a strong signal of a company's current and future financial health. Thanks for watching this video, and do not forget to subscribe to my channel.